Hi everyone, welcome back to Seven Figures. It's been a while since I've actually put together a video on this channel, but with the economy in basically turmoils and the market being extremely volatile, I thought it would be time to actually start making more episodes for this channel and sharing with all of you how the three portfolios that are very experimental doing in this environment. So for this episode, I'll go ahead and share, being very transparent, how the growth portfolio is doing, the dividend portfolio is doing, and lastly, the Boglehead portfolio, which is also known as the balanced portfolio. A special focus in this episode will be on balanced portfolios, or the last one, the Boglehead portfolio. In the past, I've actually done a deep dive on the growth as well as the dividend portfolios, specifically around finance or the financials in the dividend portfolio. That was the last episode. So for this one, I'm going to dedicate time to actually covering how a simple balanced portfolio, a set it and forget it kind of portfolio is performing in today's very volatile market, as well as unknowns that we're dealing with in the economy. So with that said, let's jump into the video and show you how the portfolios have been doing so starting with the dividend income portfolio. So far, since we opened this portfolio up, it's been up as much as like 12 to 13%. And now it's down to negative 14.95%. But you have to remember the main goal of this portfolio is to grow income. It's all about the dividends earned. They're right here, $172 earned since June when we started this portfolio. You can see it's climbed all the way up. I think at its peak, we're looking at $7,800, pretty decent return. And this portfolio right now is actually underperforming the S&P 500 by like a percentage. Part of the reason why is because of the allocation. Today, if you look at the S&P 500, uh, energy makes up around 5% of that index. And in my portfolio, energy is 9%. And that energy, if you've been looking at oil prices and energy prices, they're down significantly because we're not driving cars. There's a price war between Saudi Arabia and Russia. And so that's taken a beating in terms of the oil prices. And that's reflected in the value of these companies that are in oil exploration or natural gas. So that's down 44%. Another big loser in this portfolio would probably be, if you look at it, the alternatives. These are mainly private equities that I have in here. And luckily for me, I've kind of dodged a big bullet that I saw a lot of people dealing with on the YouTube channels that are focused on dividend investment, which is the REITs. I always kept REITs pretty low at 7% of my portfolio. I've seen people put in like 20%, 25% of their portfolios in REITs, and they've taken a beating because, well, a lot of landlords who are renting out space to retailers are not going to be able to collect because most of those retailers are in big trouble right now. We're not shopping, we're not going outside, so they can't pay their leases. And then lastly, an area that I still really believe in is the financials. The banks have to set aside more money for loan losses because as we go into a recession, they're mandated by their regulators to set aside additional monies in case we default on our loans, companies default on their loans. So investors have been selling these companies off a lot. Bank of America, Wells Fargo, JP Morgan. These are great organizations. I'm actually going to continue adding to them. I might even up this to 14, 15% of my portfolio in here. But in my retirement accounts, I've actually been buying up banks a lot more just because I think they're undervalued and they pay a great dividend. They're going to be able to continue supporting that dividend right through the crisis. So that's the dividend income portfolio. Uh, Performance, I'm okay with it. The goal of this portfolio is income. So I'm not even really worried about this. We'll just fly right through this and get to the other side and then I'll deal with it. Um, the next portfolio, which is a growth portfolio, you're going to be, a lot of people are going to be very surprised, but growth has actually been doing really, really well. At one point, I think in January or February, this portfolio was up 65%. I wasn't a braggart, so I didn't really make any videos. I probably should have. Maybe a lot more people would have been looking at those videos, but This portfolio was all the way up to 65% growth. And you can see that right here evidenced in the chart. At one point, I hadn't been adding any money to this account for a while, and just to see how much real growth is coming out of it. And at one point, we got to $10,800. And you can see in December 7th, when I last did an episode, it was at 6,800. So added $4,000 without me adding a single dollar to it. A lot of this growth came from Tesla. I'd always said, there's a video that I made a while back where I said, this is why Tesla is my largest position at 15%. Probably should have made it 20, maybe 25%. At one point, Tesla was $950. And as you'll see here, my average cost was $229. So I was way down there. And at one point, this Tesla position was worth $2,000 with a net cash flow of $765. So even today, still up 177%. Not going to sell it. Expect Tesla to go down a little bit in the coming months because they're going to miss their numbers. But I've added a little bit more to this portfolio lately, like I do to the other ones equally. So I've put in $300, and I did that to the same thing to the other portfolios just to keep things balanced. And all the companies in here are doing really well because they're monopolistic, they're required, they're needed no matter what. So Amazon's doing well during this crisis. Beyond Meat is hurting, but I expect that to come back very fast, very hard. So I'm putting actually money in it. As you can see, this is a transaction going through. Google is going to keep doing fine because it dominates search. Microsoft, if you work in the corporate world like I do, you know this is going to be just fine. You can't do anything without it. I'm using Teams all the time because we're all working remotely. We need Microsoft. Facebook, they'll be fine. They dominate social media. They're a monopoly there. Alibaba, this is just the monster in China. AMD, I own a ton of this stock in my retirement account at Vanguard. I'm up like 300% in that account because I bought this when it was $15. Today it's $50. Netflix, never really worried about it when you miss that number because believe in the company, like it a lot. I've had Netflix for 7 years, never even thought about canceling it. And then Uber, just love the company. I use Uber everywhere I go. When I'm not required to take a taxi, I'm taking Uber. So I just like the service. So I believe in the company, so I'm buying its stock. In Vinte, I'm a big believer long-term in genetics and how they're going to change the world. So this is a company that makes the nib test. And if anybody's ever had a kid, if you want to find out if the child has any hereditary diseases, the way to do it minimally invasively is with genetic testing of the mom, which gets to the child somehow. So it's called the nib test. I believe this company is going to do really, really well down the line. I'm buying more stock. As you can see, there's a transaction going through. So growth has been surprisingly really strong and really positive, and I expect it to continue, getting stronger as we get through this crisis. So that finishes up growth. Let's move to Bogleheads, where we're going to focus on this portfolio a little bit and do a deeper dive. As you can see, the market is down around 13% right now. This portfolio is only down 1.3%. This is the boring, steady as she goes portfolio. Whenever our family members or friends who are not sophisticated in investing, never done it before, they're afraid of the stock market, they ask me any questions about how to invest, I always say, do a 50-50 index fund. And we should all probably be indexers. And I am primarily an indexer. The majority of my money, 90%, probably 80 to 90% of it, is all in index funds at Vanguard. So this portfolio is really simple. It's set up as a 50-50 portfolio. So 50% Vanguard total bond market, 50% Vanguard total world stock index fund. So this covers all the stock in the world. Not every single stock, but pretty much 95% of what's out there. So you're really, really well diversified. You're not exposed to one country. You're not exposed to one geography. You're not exposed to one sector of the market. You really, have exposure spread out all over the world. If Europe comes out of this stronger than the US, you benefit from that. If Asia comes out stronger than the US, you benefit from that. If the US comes out faster, you benefit from that. So it kind of just balances things out. And I like to call it the keep it stupid. People say keep it simple, stupid. I would just say keep it simple and steady is what this portfolio is, because you can just see the steady growth here. As I added very few dollars in there every week, and then I stopped, it just kept chugging along, chugging along, chugging along, flattening up here. And when the market was going crazy, it wasn't going that crazy because as the stock market went up, the bond part of it goes down because people get out of bonds to buy more stocks to chase growth. And so it starts flattening out a little bit because the bond side is going down. And that gives you an opportunity to rebalance. So, and then when the market went down, it didn't go down as much because, well, as you can see down here, the stock market is down, the total world is down 11%, but the bond side of this portfolio is up 8.4%. And now it represents about 53% of the portfolio. I just have to go over here, hit the rebalance button. It'll sell about the $240 that are gained and buy the around $240 worth of total world index fund. Now, I'm not going to do that because I don't want to incur capital gains. This account is not more than a year old, and therefore I'll have to pay around 40% capital gains tax. After a year, I'll probably be willing to rebalance, but I don't see myself rebalancing until either one of these is at 60% or more. Then I'll try to get it back to 50-50, and then I'll eat the cost of rebalancing at that point. Part of investing is also minimizing your tax exposure. Now, if you're looking at this and you're saying, well, what do you mean? How is this better than the market? So it's down 1.3%. And if we go and look over at like Market Watch and we see how the market is doing, you can see that percentage wise, over the last 3 months, for example, the market is down, 15%. It was down as much as 31% coming into this year. So that's really what you want to measure yourself against if you're interested in beating the market. I'm not interested in that, but it shows you the safety of actually, staying kind of conservative and making sure that you're not overexposed to one asset class versus another one. Going back to the Boglehead fund here, this is what I really always recommend to people who want to set things, forget them, and go live their lives and just put money in there every week or every month or every 2 weeks, whatever your cadence is. And the next thing you know, you're gonna wake up one day and you'll be either a millionaire or you'll be pretty well off. So I hope I've covered this pretty well for anybody who's watching this video. If you like the content, please give me a thumbs up. If you like the concept and want to enjoy more of these videos, I would appreciate it if you subscribe. Thanks and have a good day.